Welcome to the Mentis podcast. Today we have Chase Hudson with Parkwest Real Estate. Thank you for coming on today.
Yeah, absolutely. It's a pleasure to be here, Nick. Thanks for having me.
Absolutely. Looking at your background as an industrial investor, it's an asset type that I do not get to talk to experts about as often, but I'm definitely eager to hear some of your insight today. You used to work at the Dakota Pacific Real Estate Company, which has a very large industrial portfolio among other large companies as well. But you're also focused on it with Parkwest as well. So, maybe give us a little bit of a background, and then we'll kind of dive into some of your expertise and kind of some market insights.
Yeah, absolutely happy to do so, Nick. So I came out of undergrad in 2017 at BYU, so Brigham Young University in Provo, Utah. Studied accounting and finance, and was fairly involved there with the real estate club. And real estate was always something that was what I wanted to do. I grew up with my grandfather being a developer up in Washington State, albeit on the smaller scale, but he did a lot of mobile home parks and apartments, and so kind of in my blood. And so coming out of BYU, I went to work for JP Morgan in their real estate Americas group. So JP Morgan has the largest core fund in the country. And what I spent 3.5 years with them in Los Angeles, investing out of their core fund, their value add fund, and then kind of a core plus fund that they ran as well. Focused along the West Coast and was product type agnostic, although we focused on kind of the four main core industrial, retail, office, and multifamily, and had a great experience there, cutting my teeth. JP Morgan, high level, I mean, they do probably 60 to 70% direct investing, where they're owning, operating the assets, and then the other 30% or so as an LP or going in with a developer on a deal. And so when I was there, we did a lot of investing into industrial real estate with developers. So JP Morgan acted as the limited partner, and we team up with operators. And it was always very interesting to see from at least a distance at that time, these developers building warehouses and working through projects, and just the opportunity that I saw there in that space. And so I wanted to make a transition into a more development focused role, a more entrepreneurial, smaller shop. When you're with a group like JP Morgan, it's as awesome as it is, and as great as the training is, it can be a little bit of a cog in the wheel sometimes. And so transition to Dakota Pacific, as you mentioned, Nick, they're in Salt Lake City. Moved from LA to Salt Lake, spent almost 2 years with them as a vice president, working mostly on industrial projects, both existing kind of on the asset management oversight of a portfolio of about 900,000 square feet of commercial assets. And then the other part of my time was on multifamily. So worked on a pretty large ground up deal in Reno, Nevada. But yeah, I had a great experience with them. And then the end game was always to do my own thing. So have been entrepreneurial at heart. Was working up the courage to make the transition and do my own thing. And so it took a few years to be able to do that and muster up the courage to do it. But at some point you need to just pull the trigger and have faith in yourself. And so made the jump in early 2022, spent some time planning, convincing a business partner to join me, and then formed Parkwest in July of 2022. So I'll take a pause there and happy to talk about what we're doing at Parkwest and what our focus is if we want to go there as well.
Sure. Well, thank you for sharing your background. It's a big jump to move to running your own shop. There's a lot of different things to consider when making that, but I think that it can be very rewarding for the right type of person. Going back and looking at some of your expertise there with having asset management and development experience with both multifamily and industrial, what can you tell us about 2023? I mean, where are we headed? I mean, we have really high interest rates. The market, especially on the industrial side, has gotten quite a bit more attention than it used to. I think that some of the smaller investors really started seeing this as like an asset type that was not going anywhere as e-commerce became more solidified in the way that we do, our businesses. And so what's next? Is there only good things coming for industrial? Are we overbuilding? Are we at the point where you have to be very selective about the market? Give us some of those insights. What does 2023 look like on that front?
Yeah, great question. So before I'll get into 2023, I think a little bit of context. So for the last 5 years, industrial has been kind of a 5 or 6, whatever, it's been really kind of the sweetheart asset class or product type within real estate, especially in the last 3 years. So with COVID-19 and the pandemic, there was a massive acceleration and shift from really within the e-commerce space, the demand for functional distribution facilities, manufacturing facilities, as groups like Amazon, DHL needed to have priority locations to be able to provide access to their customers, and to people who were shifting during a pandemic to working from home, ordering more online, ordering pretty much everything they could accessibly obtain online. And so the demand really skyrocketed, which led to a few things. So one was rents. Here in the Salt Lake Valley, where historically rents had been, 40 to 50 cents a square foot, and that's a monthly kind of triple net rent, went 25, 30% year over year for the last 3 years. And now we're in the upper, 80, 90 cent range. We're pushing $1 on a lot of these newer construction projects. And then the other side of that, and this is not specific to industrial, but construction costs, right? We saw those accelerate incredibly quickly from concrete, steel, joist and deck, just with the demand and the pinch point. So people over the last 2-3 years could not get enough industrial real estate. And that trickled through to all of the institutions, all of the private equity real estate firms. All of the developers were, let's go grab as much land as we could, and let's get as aggressive as we can. And then the other thing was land pricing. So just again, here in Salt Lake, developers were used to paying $4 to $8 a foot for dirt. And now things are trading in the high teens, low 20s, even up into the $30 a foot range for dirt, because of the demand story and the lack of supply and inventory. And so you couldn't lose in industrial real estate really over the last 5+ years. As we shift into 2023, you've seen some of the headlines, I'm sure, Amazon pulling out of some of their facilities, or giving back certain parts of their holdings, which high level may scare some investors, and I think there are some concerns there. But when you look at the fundamentals, and thinking here in Salt Lake, so just as an example, and this can be extrapolated across the country to some extent, but as of today, we're sitting still sub 2% vacancy within the greater Utah market across the industrial space. There is about 9 million square feet, 10 million square feet of supply in the pipeline, new construction. But if you were to drop that into the market today, into Utah, vacancy would only go up from about 2% to about 8%. And so that just speaks to the amount of demand that's out there. Still in our market, builders can't build quickly enough to meet the leasing demand. So the fundamentals have been still very strong from the demand side, slowing a little bit, but very resilient thus far through the inflation story and what we've seen over the past 9 to 12 months. I think, Nick, it's still a little bit of a mystery in terms of where cap rates have shifted. We were seeing new Class A products sell for sub 3 cap rates up until 9 months ago. There haven't been a lot of trades recently because I think developers don't really want to put their deals on the market and see, test the waters because of where rates are and negative leverage coming into a deal. So that's where it's a little bit uncertain. And but what has still been very resilient is the leasing, the demand from the tenant side. So going into this year, so we have a project that we're working on. I could go into more detail on that later, but we've seen a lot of developers hit pause because of interest rates, because of construction costs. We've seen developers retrading on land where they were under contract at $20 a foot, and now they can't make sense of that because their construction financing went from 3.5% or 4% to 9 or 10%. So we have seen a little bit of slowing down on the pipeline, but overall the leasing story is still strong, and a lot of developers are still hitting go. So we'll see how 2023 shakes out. I think it's industrial, cautiously optimistic, being smart about your basis in your land and your underwriting, not getting overly aggressive with how you're looking at it, but still a very great asset class. So sorry, I know that was long-winded.
No, there's a lot of great points in there. I mean, the asset class certainly isn't going anywhere. And it seems like if construction is going to slow over the next year or two, as construction rates obviously are inflated, I think that's what the Fed wants. They want to slow down on the new supply. That
Right.
should only insulate the existing product, especially if it's a modernized product type that's already, got the right ceiling heights and is set up for today's e-commerce. So what does that mean for you when you're looking at doing a new deal? Why are you able to move forward? What was your secret sauce? Did you get the basis on your land? Did you, have like some kind of a deal with a company that is giving you money ahead of time? Like, why are you able to move forward? And if people are trying to find deals to move forward right now, what should they be doing?
Yep, great question. So one quick point, you mentioned it may be an opportune time to look at existing deals, or existing inventory, non-development play. So I that is one thing that we're looking at within our company at Parkwest is we've underwritten a lot of development deals over the last 6 months, and there's still a very big bid-ask spread between a seller's expectations on where they want to sell their land and a buyer's expectations on where they need to price it to make a deal make sense. And with construction costs, like you mentioned, being so elevated, it's very hard to make a development deal make sense right now. When you're building to, right now, if you're paying, market value on land and your construction costs are what they are, new construction across Utah is pushing kind of in that $175 to $200 a foot range right now to be able to build all in. And rents are still kind of keeping up and catching up to that. But if you can't build to a kind of a cap rate or yield on cost of with above a 6% right now, it's a deal that's not going to get done. So we are looking at existing inventory, stuff that's been built in the last 20 years where rents are well below market. I think that's a really great opportunity right now, that if anyone's looking to get into industrial, because rents have grown at 30% year over year, if you bought something that was built 5 years ago or 4 years ago, those rents are probably 50% below market. If it's a 7 or 10 year lease that these tenants have been in. And so there's a big mark to market opportunity. And if you can go in and buy industrial for below replacement costs, which you can, if you can go buy a deal for $150 a foot or $125 a foot and mark rents up and then sell it. I think that's a great play. Specifically,
now, if you're doing that play though, you have to then find the right building where a lease is coming due. There's obviously tools out there to find those sort of properties. But if you were to identify one of those, are you then going to, you not only have to build in the time where you still have the existing tenant, but then you're going to have downtime of kind of maybe re-outfitting the asset, maybe doing some quick renovations, and then moving in a new tenant at the higher rent, or the existing tenant is just going to accept it and they're going to pay the higher rent that you are saying. But in a lot of those cases, I think that those leases were not negotiated with this much inflation in mind. And some of those, I guess, triggers in their leases based on like, maybe it's a CPI index or whatever they've agreed on. I guess, is there anything that's been learned on the better way to negotiate a new lease going forward so that you're protecting yourself and you're not sitting here like some of these folks who have just missed out? I mean, they just locked themselves into a 5 or 6 or 7, 10-year lease and just missed out on this huge opportunity. And now they're just collecting much, they're subpar on their rents. And, kind of going forward, what's that best practice to give the company a fair deal, but to protect yourself so that you're not sitting there, kind of just shaking your head going, man, I left a lot of money on the table.
Yeah, a couple things when it comes to commercial or industrial leases in general. One is rent escalations and thinking about how things are getting done in the market now. It's really 4% is the new standard, 3.5% to 4%, whereas historically it had been 2.5% to 3%. And that is really just inflation driven when landlords are seeing rents in the market in other properties growing at 10% and they're stuck with the lease at 3%. Tenants have come to terms with the fact that 3.5% or 4% standard lease escalation clauses is more and more common, and we'll see if that sticks. But at least right now, that's what's happening, given where inflation is. The other thing is term. So 5-year lease, a 7-year lease, a 10-year lease. Pros and cons to each of those. If you're doing a longer term lease, the benefit to that typically is if you have a really good credit tenant coming in. So there's a deal down the street from the one we're working on where Facebook just signed a 10-year lease for a data center in the building, and the landlord was willing to give a little bit of a discount on rent because they were locking in term and they're locking in credit with obviously an institutional credit tenant as Facebook is. And that's going to really benefit them on the sale when they go and sell that building. They say, hey, we've got Facebook in here, guys. Instead of paying a 6 cap or 5.5 cap, this is probably merits a 5 cap or sub 5 cap because of the credit. You've got term. It's a great story. On shorter term leases, you do have the option to turn rents over more quickly and mark rents to market. Although you have more turnover costs, TIs, leasing commissions that you're having to pay. So, you just need to be strategic about that. And typically the more tenants you have in your building, the shorter the duration of the leases typically will be, as you have more rollover and you're trying to continue to fill tenants and backfill. And then the other thing I'll mention is just on renewals. So every tenant wants an option to renew in most cases. If after a 5-year lease, they're going to want to be able to say, hey, we want to stay in this building or we want to go look elsewhere. If you're going to do that as a landlord and provide them the option, always have the renewal lease rate be at fair market value or 95% of fair market value. And if you're worried that there may be a decrease in rents, you could even set a floor as a landlord and say, rents will not, your 5-year term will not be less than your prior year rent in any case. So it's always a negotiation. Tenants are going to want their rent to just trend off of the last year. But as a landlord, you want to be able to have that opportunity to reset rents. And as a buyer too, you're going to want to have that opportunity to reset rents when you come into a new deal.
It really sounds like it's going to be case by case. And what's your capital structure? Are you looking for cash flow? Are you looking for long-term appreciation? Are you just looking for depreciation benefits? Are you, maybe got another play where you want to have an anchor tenant and you have a few smaller tenants that you're going to try to escalate those folks on it. That's what I love about real estate. It really is a, kind of case by case, and you can negotiate each point. But great insight on doing fair market value with 95% or 95% fair market value with a floor. That does seem like it should be fair. It'll be interesting to see how some of these companies react or what they start negotiating in the years to come as things continue to change, and hopefully inflation comes back down, and I'm sure they're going to hope that the 4% increases are going to come back down. But
right.
probably not in the near term. I think that, at the end of the day, that these spaces are supposed to be paying for themselves. There's a reason that they want them, that it's helping them either with, just better logistics or last mile or whatever it might be, that these companies should really be seeing a profit on whatever rent they're paying there.
Yeah. And
So,
it's just math, right? So
yeah,
when construction costs are X and the building costs X, and the only way a deal gets built is if returns are Y, you solve for what rent needs to be. And and because the lack of inventory and the vacancy, tenants, it's shifting a little bit. But the last 3 years has been a very much a landlord market where landlords can say, I know rents were 80 cents a year ago, but now it's 95 cents. And the tenant has been willing to pay that. And so as long as construction costs keep going up and demand keeps, stay strong, rents are going to continue to increase, and tenants are going to be hopefully willing to pay those rents.
yeah. I mean, it certainly is a compelling story on both sides. I think that it's a win-win if it's structured correctly. The asset class obviously has lower capex, and there's not as I guess maybe hands-on management. And typically, if people aren't paying, there's somebody else to kind of come in and take over the space. And you try to mitigate that with some credit worthiness before you put people into the space. And I think that's what has attracted people a lot. But it has been interesting to see some of the news this year, kind of for the first time, see some hesitation on the investment. But it doesn't seem like the large guys, like the guys who are owning huge portfolios, the Blackstones, Prologics, those folks, seems like they're just really investing for the long term and are still quite bullish on this space. And I don't think it's going anywhere if you have good land that fits this build. I don't think
I agree. I think it's very dependent upon how these firms are capitalized. So, for example, there's merchant builders, and then there's long-term hold, builders, right? Or, evergreen type developers. Right now we sit more in the merchant build. So we're going to be building, leasing, selling, right? 3-year hold, maybe 4, getting in and out of deals, building a track record, recycling capital for investors. But then you have the Prologises, these groups that are self-sustaining, or they have institutional partners that are longer term investors. And for those groups, so just an example, Hines, who's a prominent national developer, they paid the highest watermark, or they're at least under contract to close the highest watermark for a piece of land within Salt Lake that the market had seen. And I went and had a conversation with them and just said, how are you guys making this make sense? We couldn't do that. And their answer was, it's our capital. They have slightly lower, maybe potentially lower return thresholds, or they have a longer term vision. They're looking to cash flow it over a 10 or 15 year period, where they may not need the big juicy IRR over a 3-year hold. And so these bigger groups, I still think cautiously optimistic. We have seen some pullback. We have seen developers say we're gonna sit on this land for a little bit and see what happens. But groups, and this goes back to your other question, how are we moving forward with our deal that we have here in Salt Lake? I think if you have a good land basis, you have been able to de-risk the site from an entitlement standpoint and lock in construction pricing, which we effectively have, then the demand story is still there on the leasing side. The growth is still there. We still feel good about proceeding, especially given we're going to be building for about a year. We're going to be done with this project in 2024. Hopefully the markets have stabilized a little bit. And so, again, it's just, you got to be selective. You've got to make sure your debt's lined up, your equity's lined up, and that you've got a good basis and feel good about the rent and demand story. And if those things check the box and your location's there and you feel like you can make it work, you're building to above a 6% yield on cost right now, then we still feel pretty good about these types of deals.
Makes sense. Just like you said, it's just math, X, Y, and Z, and solving for rent. So with the development side, that has definitely been a real sore point with the construction cost over the last really 2 years. Just this inflation just kind of swept in. And I know that, we talk about 8, 9, 10% inflation in the market, but I really think that in the construction space, it was more in the 20, 30%, depending on, what particular material you're talking about.
Yeah.
So how do you manage your risk with locking in construction prices? We all know that there's a guaranteed maximum price that you can sign with your general contractor, who's supposed to have, certain escalation clauses, or maybe the escalation clause is something that's really being visited for the first time, for a lot of these GCs. But what mechanism are you putting in your deal, or what agreement have you made with your contractor to ensure that all of a sudden you're not looking at a $25 million deal becoming a $30 million deal, which so many did over the last 2 years?
Yeah, they definitely did. Prior to starting Parkwest, I was working at another firm, and we saw that same thing where construction went from where we thought we had a number, and it went up $20 a foot because of 25, 30% increases in concrete and steel and all of that.
And you just didn't have a choice. I mean, it was, you either pay it or you're just not getting the building. It wasn't like a lack of shopping. There was just simply an increase in cost across the industry. It unfortunately definitely caused a lot of pain for a lot of people. We know all too well just how important it is to manage those costs. But I guess what did you learn from that, and what are you doing going forward?
Yeah, so what we learned from that is if you're modeling a development deal, a pro forma, you should always carry some form of cost escalation, because
separate from contingency.
That separate from contingency is what we've done. So typically what we'll have is there's a general contractor contingency that's typically baked in somewhere or another to their bid.
Okay. So what percentage are you giving that? Like a 3-5%?
Yeah. Usually a contractor will have a 3% GC contingency within their budget.
GC contingency, that's one bucket. Do you have an owner contingency?
And then an owner contingency is another bucket. And that's
on the full deal. How are you calculating that? Full deal, or just on the actual hard cost?
Yeah, hard costs and soft costs.
Okay. Yep. Two different buckets.
Two different owner contingencies.
You're adding a third layer here.
And we're adding a third layer.
Yeah. What's that percentage of owner contingency?
So if we're just doing if this is a first pass on a deal, and we've gotten a ROM budget, or rough order of magnitude budget, from a contractor, we'll typically throw 7 to 10% on top of that. As an owner contingency, just because they at that point, they haven't really dug into the site. They may not have, we don't have a survey yet. We haven't had a geotechnical. We don't know the soils. And so usually we'll just, if we're going to throw an offer in on a piece of land, it's 7 to 10% owner just on top of that, off of their initial bid. And then the third layer, and this is kind of from the scars that we had from that 1 or 2 projects, where it was like, we literally were getting 25, 30% increases on stuff. So we've toned it down a little bit, but it was 5% or 10% annual cost escalations. And so what we do, it's a little technical, but we would say, if we're going to put this deal under if today's the day, so let's say it's January 12th, we plug that date in our model, and then we'd say, what's the estimated construction start date? And let's say it's 9 months from now. So we'd say from January to September, that's 3/4 of a year. We'd take that and we kind of annualize that construction inflation number at 5 or 10%. And then we'd add that on top. So it would end up being, if it's 5%, probably around 3.5% additional on top of your owner. And then if it's a 10%, it would be 7.5%. So it ends up being like a lot of contingency, which you have to be careful, because it could kill a deal.
You outlined 15%.
Yeah, pretty much. Yeah.
Now, you're leading me right where I was thinking as well. It can kill a deal, and you're at 15%. You're looking at it and you go, maybe we'll get away with 13%. What does that look like? Oh, maybe we'll get down to 12. And a lot of people, before we had any of these crazy inflation, because I don't think a lot of people have experienced this, I think a lot of people got quite bullish. I mean, I was hearing about deals where, total contingency on the whole thing, maybe a couple percent. I mean, total, and it really not not really giving any type of room for any type of situation like this. And then you're just doing cash calls. So what are you guys doing to make sure it's not killing the deal? Or are you just simply saying that's our criteria, period?
Yeah, it's such a good question, because you don't want to kill a deal. You want to get deals done. And as a newer group, right, we're like, we want to tie stuff up and we want to execute. But at the same time, your first, second, third deal, if they don't go well, they could be some of your last, right? And so you have to understand, at some point you're going to get in front of equity. You're gonna have to convince them that your assumptions are sound. And one of the hardest things is you're gonna have to get in front of debt and a lender. And we're working through that process right now. And their baseline is a 7% contingency on top of the hard cost construction.
Yeah, I've talked to some who want 10%, and
yeah,
they want like a 2-year of escrow on interest at like, what they'll trend is maybe like a 9% or 10% right now. So they now don't just want a very somewhat aggressive, maybe like maybe you're looking at it and you're like saying, I'm going to draw X% per month, and that's the amount of interest I'll pay on those fewer dollars.
mm-hmm.
I think the banks are saying you're fully, like, we're going to model it as if you're fully drawn day one for the first 2 years at like 8 or 9%. They add that on top of 15% contingency. All of a sudden, you're looking at these things going, this doesn't make any sense. And I think that's exactly where a lot of deals are going to sit for a while right now. I don't think they're going to die off permanently, but I think there's going to be this back and forth with the lenders or the contractors, and it's going to be this continual like circle of, well, can you guarantee, can we fix this, can we and go back to the banks. Okay, they're going to get guarantee that 80% of the project costs are 100% fixed, or they have to put the money in, and then the lender is going to maybe come down to 6, or I think that's going to be this dance that we're all going to have to play to see how deals are going to shake out. But certainly interesting to hear that you're kind of coming to the same conclusion on, you got to underwrite more conservatively right now, and if you don't, you're going to be up a creek that you probably don't want to.
Yep, exactly. And I will say, in the last couple months, so the feedback we've received from our contractor and other groups is that so there was just a big increase in concrete in January and this month, but other subs and other line items are actually showing a little bit of softening in pricing, and so, as well as lead times. Steel, joist and deck, things for the roof structure for an industrial building were historic. I mean, about 6 months ago, peak, inflation peak, supply chain crisis was taking a year, 14 months to get delivered. And so that's come down a little bit, which is positive. And it's all just a result of, the Fed, the inflation, people hitting pause on deals, pipeline, slowing a little bit. And subs are going to have to be more and more honest, right? It's like, the true markup is a lot of times in the margins, and just where subs are saying, we're so busy that we're just going to throw a price out there and see if they take it. And that's what had happened over the last 2 years, is everyone was just slammed. It was like, okay, if you want to use this for your concrete, here's a number. We've got 30 other jobs, and people were taking it. So it just added to the problem, right? And so now we're seeing some of that softening a little bit. And so we've shifted where maybe instead of a 15 or 20% contingency on a deal, maybe we will just take our hard and soft, slap a 10% on hard and 10% on soft as an owner, and just we'll use that kind of as the initial, gut check. Because we don't want to kill a deal. It's still a very competitive market. And so it's a balance.
Yeah, the sub aspect of this is certainly something that's not really talked about as much. They were getting larger margins, but at the same time, they also were having the same difficulties with employment that everybody else was having. So they're now having guys come to them saying, you used to pay me $18 an hour, but I can go literally down the street and make $22.50. And then they would do it. They'd go make $22.50, and then they go right down the street and make $25. And you can't really hire a big workforce and then go back to them with inflation happening globally. They're trying to feed their family and say, hey, you need to take a pay cut. So in a lot of ways, with this, labor is going to kind of hold construction prices up. Like, maybe we're going to see some, relief, but I'm not sure that the relief is going to be this massive reduction in cost that I think people are expecting, as much as just holding steady, which is what we've been able to do for so long, where you get a number and 6 months later, it was still a good number to use, for your project. I hope that it does come down a little bit, but I remain a little leery of people who are projecting that the costs are just going to kind of go back to where they were. I think the cat's out of the bag on that.
Yeah, no, I think that's a great point, Nick. Yeah, and I agree with that sentiment.
But at the same time, go to the rent side of the equation, it's higher, so I think right now, if we could all see a little bit of relief on the interest rate side, I think that would be a big help on everything. I know that we kind of need to get inflation down, but it's hard to say that this wasn't a self-inflicted problem, but
yeah,
that's a whole nother conversation.
Yeah.
So
yeah, exactly. Agreed.
So tell me about, what does the next year look like for you? You mentioned your industrial project. You're obviously a multifamily investor. We really haven't gotten much into that as well. Where are you spending your time right now? Are you looking at, kind of value add multifamily? Are you looking at industrial? Is it just new construction? I know that you want to be a developer, but, what's making sense right now, and, which markets?
Yeah, good question. So we are focused on multifamily and industrial. The other half of our business is my business partner named Justin Hathan. His background is very focused on the multifamily side. Spent several years with Bridge Investment Group and another smaller private equity firm. So we are right now. We had a meeting in December, kind of annual planning, talking through this. We've underwritten a lot of deals over the last 6 months, and it's been hard to find something that pencils. And again, the bid-ask spread between sellers' expectations and buyers, where buyers need to be, where debt is. When you're putting together a 5-year fixed rate loan for an apartment building at, it changes every day, it seems like, but 5.75 or almost 6%, and sellers still want to sell you a deal at a 4 cap. It just doesn't work. So we're getting frustrated with, like, man, we think this is a great deal, great market. We love the business plan, but there's just, so what we're thinking. So we've got this industrial project that's hopefully kicking off in the spring. That'll be a 230,000 square foot warehouse, single building, kind of class A, 36-foot clear. So that's our next big one. And then we do own part owners. We're co-GPs in a deal in San Antonio, 636 unit value add profile, 2-property portfolio that we close on in July. And so we've got the value add, we've got industrial development deal. Moving into 2023, for us right now, I think we're going to be focusing a bit more on acquisitions and a bit more on the multifamily side. One, because right now lead times for development are still really, really long. We needed some fees as a newer company, right? Got to keep the lights on. That's really important to us. And so, for example, this deal, this deal we've been working on in Salt Lake, we got it under contract in March of 2022. And so it'll be almost 18 months of entitlement. We had to get it rezoned. We had to get a site plan approved. We had a plat. There's a floodplain we're removing. So there's,
I know that seems like a long time, but really in the development world, it's par for the course or longer. I mean, you could be 3, 4, 5, depending on the size of the project, you'd be talking, 10 years to get something done.
Yeah, exactly. And combine the entitlement risk with the uncertainty around construction costs and interest rates. We just are thinking best path to execution right now. Let's go find some really great off-market multi deals. We're focused in Texas heavily, and then Utah. Really it's Sunbelt and Intermountain West, but because it's just two-man shop right now, we're really focused on Utah, Idaho, Texas, and some of the surrounding states there. But really heavily focused on
in those states. You're looking for like a multifamily investment. You're looking for debt assumptions. Are you looking for a value add play? You're just looking for mismanagement. You're just looking for debt that's maturing. Where are you at on your kind of criteria for picking a multifamily asset right now?
Yep. Great question. Debt assumptions are awesome. We love debt assumptions. If we can get a deal that, has a 5 years of term, maybe a year or two of IO left on it, where we're sub 4% or even around, 4% on the fixed rate, We'd love that all day. So that's a big focus criteria. So we have CoStar, we have a couple other tools where we are focusing on some of the loans that are maturing where, and I'm, sure you're very familiar with this concept, right? But a lot of deals got done in 2021 and 2022 with floating rate bridge debt. And as those 2-year or 3-year terms come due, and there, a lot of them probably didn't have rate caps before rate caps were a big component.
Well, a lot of people got prices for rate caps in, I don't know, 5-10 years ago, or, over the past decade. I mean, it's not like it's a new concept, but like a lot of people would just price them out of the deal. They're like, yeah, we can get, it's not going up. There's no chance the interest rates are going to double. No, we don't need that extra couple $100,000 in the deal. And it's, I'm sure history will repeat itself, but it is interesting to see how people are, at the end of cycles are much more bullish on things. But, I think rate caps or structuring it in a way that you have a fixed rate debt, or you have a swap loan that puts you in a position to be kind of reaping the reward of interest rates going up. Something like that needs to be, kind of in the underwriting process, just to make sure that you're really not, again, going up a creek that you don't want to.
Yeah, super important. So we're looking, I don't think we've seen the blood in the water as much as we will probably see over the next 12 or 18 months, is assuming rates continue to trend up and stay kind of where they are.
Yep.
Where groups did a bridge loan at 85% loan to cost at their starting rate was a 3.5%, but it was floating, and now it's 7, 8, and they can't refinance.
I mean, they're not even making debt service right now in most cases, especially if they have high eviction, backlog from COVID or something like that.
Yeah.
There's definitely deals that are distressed, but I don't know how to, like, my feel on the market is that they just are still hiding it from plain view. As they just start losing more and more, I think it's going to be quite apparent who's actually got, who's in trouble and who's got the cash to kind of come in and save the day. But there's definitely going to be some losses coming. I just don't see how you avoid it.
Agreed. So we're looking at deals like that to potentially come up, and then just general criteria. So we're 80s and newer vintage. Ideally 100+ units. We can kind of be a little flexible there. Good submarkets of Dallas, of Georgia, Utah, Idaho, and really off market is our focus. So because we're a newer group, trying to find good deals, and we have great broker relationships, and we talk with them on a weekly basis. But if it's a fully marketed deal that's gone out to the masses, there's going to be a best and final. It's just tough, one, from kind of the returns we're trying to hit, and then two, just from a competitive environment, getting those across the finish line. So we actually are heavily focused on we have an assistant. Her full-time gig is just purely outreach to owners. So we'll do a CoStar export based on our criteria, the vintage, the unit sizes, where we like pockets, and then we'll just send her over 500 properties and be like, go to town. We need to get in front of all these owners. And it's tough. Owners either, hey, we're not selling. Hey, we don't do off market. Who are you guys? Right there. But we're just trying to be at the right place at the right time, and cast a wide net, and eventually something will stick. So that's our focus right now. Getting this deal across the finish line in Salt Lake, and then finding the next opportunity.
Makes sense. It sounds like you guys are up to a lot of hard work, and I'm sure 2023 will be, quite a good growth year for you, regardless of what's happening in the economy. And I think a lot of folks who get started in adverse situations like what we're kind of facing right now just makes you better. I mean, if you guys can figure it out right now, it seems like you'll be able to kind of have some easy tides here in the future. Hopefully, at least that's for everybody.
That's what we're hoping. This is probably the hardest time to, probably second hardest time in the last 20 years to start a real estate investment company outside of 2008 or 2009. Right. So we're optimistic. We think that we're grateful to be starting now, as opposed to in 2021 or 2022 and bought, a few deals, and now them all be underwater. Right. Like, so I think our timing is good. All things considered. It's tough, but it's better than most. So we're excited.
yeah, I mean, there's a lot to be, lot to be grateful for, a lot to look forward to. And, I really appreciate you kind of giving us your insights, definitely with your experience, getting to work with such large companies, getting to bring that down to a smaller group is, I really think a really smart way for real estate professionals to get started. And, really appreciate you coming on and giving us all of that, insight today. If people want to reach out and get in contact with you to learn some more, where can they find you?
Yeah. You can go to our website. So it's parkwestre.com,
Okay,
or you can follow me or send me a DM on Instagram. It's official Chase Hudson.
perfect. Well, hope you have a good rest of your day and best of luck on the new investments.
Yeah. Thanks a lot, Nick. This has been great. A lot of fun. Appreciate the time.
Likewise. Bye.
Alrighty. Bye.